Have you ever wondered how they make a determination on the prime rate, or actually the Wall Street Journal prime rate? And one of the reasons why that rate is very important, especially for SBA loans, because most, not all, but most SBA loans or 7A loans are tied to that prime interest rate. And what is it, how does it determine? So the prime rate is the Wall Street Journal prime rate is an average of the prime rates of the 10 largest banks here in the United States, and what they charge to their most creditworthy customers for short-term loans. And most creditworthy, and most of these are the really large businesses that they're lending to. And how they calculate it is by surveying these banks, and then when at least 7 out of those 10 banks change their prime rate, then they'll republish their rates. And what influences the rate is really heavily influenced by the federal funds rate, and the federal fund, which is set by the Federal Reserve, and the Federal Reserve lends money to those big banks. And typically the prime rate, Wall Street prime rate, is 3% higher than the federal funds rate that they lend to those banks and financial institutions. And this rate basically is a benchmark for various types of loans, and including mortgages, home equity lines of credit, car loans, and and then business loans as well. And banks use it as a starting point, and then based on that borrower's credit worthiness, they'll make a margin over that. And these rates of the U.S. Wall Street Journal prime rate is published regularly in the Wall Street Journal, and for those businesses, borrowers, lenders alike, they utilize that information to make a determination on that. And so there you go. Definitely follow us for more information. Of course, in the bottom, join our Keys for Business Masterclass, where we show business owners how to get access to capital without actually taking out a business loan or giving up ownership in their business or putting up assets like their house. So join us for that. Talk to you soon.